Good afternoon, everyone. We're just going to allow a couple of minutes for more people to log in. We will be starting shortly. Stay tuned. Good afternoon, everyone. This is Marianella Collado. I am the CEO and Senior Financial Advisor here with Tobias Financial Advisors. I'm here with Matt Sainholtz.
Good afternoon.
And Matt is Senior Financial Advisor and our Chief Investment Officer. So I'm going to just pass it off to Matt to walk us through a couple of housekeeping items before we get started.
Sure. Hi, everybody. Thanks for taking the time out of your day to tune in to our webinar covering the third quarter market results and some thoughts of what we're seeing on how we're going to be moving forward over the next year or two in the economy and the economic markets and kind of what we're seeing out there. But before we dive into the meat of our presentation, we have some just general disclaimers, of course, disclosures that, this is an informational session. We are going to be talking generically and broadly about markets and what's happening outside of the global economy. Please be sure to contact your Tobias Financial Advisors to talk about your specific portfolio. Once again, our comments are going to be broad and general and may not pertain to your unique situation.
So just briefly, a little bit about us. We were founded in 1980 by Mr. Benjamin Tobias. We currently have over $350 million in assets under management. Those assets are for families, related trusts, their employee plans, family entities, and what have you, all over the spectrum. We have over 75 years of cumulative experience in financial planning matters, from investment management to tax planning, retirement planning, all over the gamut of wealth management planning. And what's important to us as a firm is that we all have designations that are relevant and super important in the financial planning world. We're CPAs, Certified Financial Planners. So one of the things before we dive into markets is just reminding you all that financial planning and wealth management, the most important aspect of it is the ability to control the things that we can control. I often use the story that, portfolio returns, while they're important, it becomes a little bit more important what it is you're able to keep after taxes. So it's a lot about making sure that a portfolio is designed to meet your goals, okay? It's not about chasing market returns, but that the portfolio is designed in a way to help you meet your goals, whatever those goals are. It's about making sure that you're broadly diversified. It's the idea that you want to participate in market upside, but more importantly, protect you on the market downside. And with that, some of the key components are all about reducing expenses and controlling the tax implications. So one of our most important seasons are coming up with year-end tax planning. And that's really where you're able to control what I call sort of like the bleeding on the back end. So you can have stellar investment returns, but if you're not doing any of the planning, it pretty much offsets a lot of the portfolio returns. So the planning becomes key, because that's one of the few things that we can control. No one has a crystal ball and is able to control markets. So it's really all about the holistic planning aspect.
So another piece of just housekeeping before, as we're moving on to our next, reviewing our agenda today, there is a opportunity to ask questions through your webinar app today. If anyone would like to enter any questions, we'll see if we have time at the end, and we'll try to address as many questions as we can as they do come into our webinar here today. So today's agenda, we're pretty much going to be focusing on some major client talking points, what we're hearing from our clients and what we're hearing some of our colleagues talk about, and some of the economists and market practitioners that we follow and watch and listen to. What are people asking about? And that's about the U.S. returns, how are diversified portfolios returning this year, and what about those elections that are coming up sooner than we think, just in about 3 weeks from now. And so that's kind of one piece of our presentation today. Secondly, we'll be just updating in a general sense about what has been happening in the market, taking a look at the stock markets, the equity markets around the world, as well as fixed income. We're seeing rising rates, the U.S. Federal Reserve increasing interest rates, and what kind of effect are we seeing is that having in the marketplace? And we'll just also take a look at some general outlook and insights as to what may occur the rest of the year and as we move forward into 2019.
Okay, excellent. And I love this chart, Matt. I love that you included this here, because I think call after call that I've been getting lately is really just related to the fact that the S&P has been having a phenomenal year. So I think this is a really good presentation of how we can put this in perspective. I think we're all experiencing what we're calling S&P envy. The S&P is doing great, Nella. Why is my portfolio not capturing that particular return? So I just want to educate you a little bit on what is the S&P, and is this a good perspective for our clients to be using to gauge performance in their portfolio? So S&P, and Matt, you can chime in, is really specifically U.S. So you're just looking at literally 500 companies that are U.S. based. So in the grand scheme of things, this is essentially not the right index, sort of say, or not the right comparison that you should be using to compare your portfolio return. But I think what we get out of this particular slide is the fact that the importance of a diversified portfolio and why. And I often tell people, if you're investing in just one asset class, let's call that S&P 500, you're going to experience some wild swings between upside and downside. And so what studies and what data shows us is that while you might feel good during that S&P upside, when you have that downside, it takes you longer to recover. So that's why it's so essential to have a diversified portfolio. But I want to talk about sort of emotions and sentiment during all the different market performance. So if we look at the period of 2000 to 2002, the S&P was down 37.6%.
That was the tech bubble bursting.
Exactly. And then a diversified portfolio during that same period was down, while it's still painful, was down only 13.3%. So there it's the showcasing the importance of having that diversified portfolio, because on the downside, it protects you. And then if we look at the period of 2003 to 2007, S&P up 82%, a diversified portfolio only up 57%. Usually the calls we get, Matt, during that time all relate to, well, why is my portfolio not up as much? But remember, it's this whole concept of having a smooth ride among all of the different asset classes. And so usually, it's the calls of why am I not doing better? Should I be doing better? How could I do better? But then this goes back to our whole educational piece on the importance of diversified portfolio. And then we look at 2008. So S&P down 37%, diversified portfolio, while it's I'm going to say only 20, but still better than almost double at 37%. So it's still investors, are questioning, now I lost money. So this is the kind of the cycle of emotion with when it comes to investing. But I think the big takeaway here is if you look at total returns, let's focus on total returns. Just for someone who was just invested on the S&P and who was really riding this wild roller coaster over a 18-year period, the portfolio was still up. It was up 185%. Okay, so $100,000 invested in 2000 would result in a $284,000 balance 18 years later if they were just invested in the S&P. And then let's take that same portfolio, but now invested in a diversified way, globally diversified portfolio. So they're experiencing international, U.S., fixed, equity. So they're kind of grabbing a piece of all those different asset classes. This portfolio, while it didn't experience the huge upswing, it also didn't experience the huge downswings. And so what data shows us is that when you have a portfolio that has more of a smooth ride, at the end of the day, they have a better outcome and probably not as nerve-wracking as a portfolio that was 100% S&P. So this same investor, had they used a diversified portfolio, would have had a balance of 291,000 18 years later. So again, it's really a matter, bottom line, it boils down to controlling our emotions when different asset classes are behaving in different ways.
Right, and that kind of goes into our next presentation, but that really is what we're trying to accomplish, and what a diversified, balanced portfolio tries to accomplish is kind of the rolling hills compared to peaks, mountain peaks and deep valleys, where you're almost like a big roller coaster. And what we prefer to see is more along the lines of rolling hills, and we're not really going to be the highest earner in different asset classes when you're holding a basket of different asset classes. So this one is one of our favorites. We show this one often. We call this one the quilt chart, or at least I do, because it looks like a bunch of quilt patches to me. And what it is each color represents a different asset class. And across the left to right is the different years. And so if we just pick one, let's do one color, the orange, which is smaller companies in the United States. You could see in the early 2000s, it was kind of on the top of the chart, and then 2006 to 2007 towards the bottom. And there's really no indication as you go from left to right, from 2003 to 2017, or even year to date, where that orange box is going to be. It's next to impossible. Our core belief is it's next to impossible to really time the market and time the asset classes and say, oh, U.S. is going to do this well this year, so we're going to go all in the U.S. and vice versa into getting out of emerging markets, for example. So these, if you just pick a color, it represents different asset classes, and then the big line through the middle of the chart, you can see it's never at the top, it's never at the bottom. This is kind of like the rolling hill, where you're getting a good solid return and you're not experiencing such volatility in your portfolio. And that's kind of what it helps clients and our friends and even ourselves as investors, because we're invested just the same as long as our clients and the mutual funds that we use and the different portfolio structures. Our money personally is just invested as like yours as well. And so it just gives us an opportunity to show that being a diversified approach has over time paid off. Now, if we're looking at year to date, which is the highlighted black box there up and down, you see the orange and the green there leading as of September 30th. Well, that's the U.S. And that's why we had the previous chart there called S&P Envy, which is S&P 500 is a barometer of U.S. stock. That has done the best this year so far compared to other asset classes, whether that be emerging market stocks, developed foreign countries like Europe, Germany, France, these types of Japan, these types of developed countries, even fixed income, which is conservative, usually the bonds type of part of your portfolio, and cash.
Even those are down just because of rising interest rates.
Right. It's like one of these years, that's kind of also another thing that is to the emotional part of the investing that we try to peel apart or pull away. Looking back to 16 and 17, 16 a balanced portfolio was up 8%. Just last year in 17, a balanced portfolio was up 14%. And then as of 9/30, balanced portfolios might be up 1 or 2%. And then even into October, going into the fourth quarter, we've seen the volatility come back to the United States and across the world. A balanced portfolio may only be up or maybe even be negative 1 or 2%. My point is that we have to be ready as investors. If we're going to there is no risk without reward. We have to be ready to ride some of these ups and downs, knowing that for our time horizon, our own personal time horizon, that we're investing to meet a longer term goal for most clients, and that's how we're investing. We're long-term investors. So we want to keep that in the back of our mind, that we're going to have an up and down year here and there. We'll even have a negative year here.
I think I like how, I think it was Warren Buffett who puts it, that if you can't be a long-term investor, you shouldn't be investing at all. And I think this is it. You don't invest in a portfolio with the idea that you're going to need these funds in 3 months, 6 months, a year. I mean, you obviously need time on your side to be able to ride this wave. And in the long term, you'll see the benefits of having that diversified portfolio. And one thing that I think I want to point out is, because a lot of clients are saying, well, why do I want to be international? Why am I invested outside of the U.S.? And if we look at this kind of annualized return for the period from 2003 to 2017, you'll see that over this entire period, emerging markets has been the leading asset class. But we wouldn't go all emerging markets because it also comes with the highest volatility. It's an important part of a portfolio. It has a part to play. And I think one of the things we had recently looked at as well is a portfolio that was just 100% S&P, would have looked something like, 9% over the same period of time. So again, this is the importance of a diversified portfolio, is that you're going to control the different performance in all the asset classes.
Great point. Absolutely. So another thing that we really can't control, which is government control. We have one vote here, but in the United States. But this is kind of a timely graphic that we just wanted to put up and share relating to the elections coming up in November. And we often get questions about, well, if the Republicans win, this is going to happen. If the Democrats win, this is going to happen. And so this is like over the long term. I'll quickly run through what this is showing. So the top portion, the top graph is the S&P 500, again, kind of the benchmark for the United States stock market. What it's done over a rolling 6-month return since 1947 to 2017, and who was in control. So 11% of the time, Republicans had both control of the presidency and the House of Congress, and so that 11% of the time, Republicans, we had a 6% return. When it's been a divided government, which is most of the time, it's been a 4% average return. And that's from the stock market's parameters. And then on the bottom chart there is the real GDP, or economic growth, as measured by the GDP, the gross domestic product. You can see that kind of flips, where now when Democrats are in control, the economy is doing better from that metric. But on the divided sense, it's over time, over the long run, it's about 2.8% real GDP over that time period. What is this really telling us, Nella? I have to say that part of it is that you really, again, and this is going to be the mantra today, is that you really can't time the market. You can't control what you're going to can control. I mean, just thinking about the presidential election 2 years ago when President Trump was elected, the pundits, the market practitioners, it was going to be bad news for the economy. And then as soon as he got elected, the markets rallied, where it could have been vice versa. I'm not trying to be political. I'm just saying that it's hard to predict. President's job is only one person, and it's hard to predict what's going to happen next as far as government control.
That's nicely said, Matt. Again, if I think back to conversations 2 years ago and calls on either side of the spectrum, people who were excited and looking to really, invest more with the potential change in presidency, and then folks who, were saying, I want to, I want to get more conservative. I want to make sure that reposition my portfolio more to cash, get out of markets because of all the uncertainty. So at the end of the day, what this is showing us is that, regardless of who's in office, who's in control, it doesn't really tell us any real data that we can use to reposition portfolios at the end of the day.
Mm-hmm. So let's just recap quickly of what's been happening in the third quarter in the global marketplace. So we showed the previous chart about year-to-date returns. So this is just focusing on the previous quarter, the third quarter ending September 30th. U.S. stock markets were up 7%, and international up slightly, emerging debt market down 1%, and the bond markets up 0.02% in the U.S., and the global bond markets down slightly to 0.17%. And so some of the things that have happened in the U.S. markets, it's really been kind of a dichotomy of what's, the broader market has really been being led by just a couple of sectors. It's not that the entire market, when you kind of break apart the market into about 10 sectors, which we typically do, we have technology and healthcare kind of being some of the leaders of the markets this year that have really been carrying the U.S. markets up to that 7% return there in the third quarter. So it hasn't been quite so much of a broad-based approach, and we've seen some of the different sectors kind of lead it, which we're starting to see in the last couple of weeks, where now those leading sectors are starting to kind of pull back a little bit, and that's kind of been dry. It's almost the higher they fall, the faster they fall sort of mentality. Recently, in the last couple of weeks, we've seen some of the growth stocks and some of the higher leading technology companies that have been doing so well, and that these companies that are just keep continuing to grow have actually been pulled back in the last few weeks here in October during this little bit of a pullback that we're experiencing right now.
So Matt, maybe we talk a little bit about what in the U.S. stock market, because if I look at this chart and I kind of think about maybe my own portfolio return, and I'd question, well, if U.S. markets are up 7, international up 1, and emerging markets, I hold a little bit of that, but that's only down 1. Tell me, shouldn't I look to be somewhere around 4%, kind of just adding numbers across the board? But let's talk a little bit about that slice in U.S. stock market. What's in there, and why might our clients not see somewhere up around 4 or 5%? Let's talk a little bit about that slice.
Okay, in the U.S. slice of a global asset allocation, the U.S. stock market's return. There's typically there's a lot of different ways to classify stocks or equities. One being growth stocks versus value, and really quickly would be growth stocks would be your stocks that are high profitability, more high risk, I would say. Really,
the Facebooks of the world.
Right. So more like the Facebooks, where some companies might not even be making money, but they're gaining market share, and so the prospects of them growing into this bigger company, revenue-producing company, would have people are willing to pay more for that.
Mm-hmm.
Whereas value stocks are really, compared to their accounting on their corporate books and to how they're being priced in the market, these are often dividend payers as well. So these are companies that pay a dividend, maybe a little bit more stable within the U.S. market. So growth has been outpacing U.S. Value stocks for the past couple of years now, and we tend to shift towards, again, going with the idea that we want to have more of a smoother ride for our clients, even though sometimes it might not be looked to be the best part of the market to be in, or the highest performing market. But over time, the value, the dividend payers, those types of companies add to the portfolio and really kind of give it lessens the volatility and gives us over time a longer, better balanced approach.
That's good.
So international, we do believe in a globally balanced portfolio. I'll draw your eyes to the chart on the top right here, where as a percentage of the entire universe of companies that you could invest in and where they're headquartered or domiciled, only 55% of the world stock markets are headquartered in the United States. And so we have 11% in emerging markets and so on and so forth. So, the idea here is that, if we were just looking at the United States as where to invest, we're really limiting ourselves and limiting the opportunities set that's available to us as to how to control what we control, which is less in risk and less of volatility. As Nella alluded to earlier, like why would we even want to be in international? It's the same concept. It's a simple concept. It's hard to sometimes, when the markets are going one way or this way, it's hard to rationalize. We got to keep reminding ourselves that it's not the all eggs in one basket approach. There's periods of times when the United States will be doing better, and periods of times when our global neighbors are going to be doing just as well. So.
Right, and I think back to your point, if you look at what makes up global equity markets, it's not all U.S. I mean, we want to be able to capture global equity markets. So in order to do that, we have to go outside of the U.S. And in fact, what we're seeing is that valuations, and maybe we'll talk about this in a little bit, but that question of how are U.S. markets overpriced? And we don't think they're overpriced, but they're kind of in their average. But we see more opportunity outside of the U.S. So essentially, if we become short-sighted and say, well, U.S. is doing well, let's go all U.S. Potentially, this can harm the portfolio in the long run, just because there is more opportunity outside of the U.S. Those valuations are actually below their historical average.
Right.
So we can't be short-sighted and act in the moment at the risk of losing potentially that global return.
Right. Great point, Nella. So fixed income, or in other words, bonds, are very much affected by interest rates. So what happens when interest rates rise? The value of your bond that you're holding goes down, because now on the marketplace there are new bonds that you could purchase that have a higher yield or a higher interest rate that you could invest in. So your current bonds that were issued maybe a year ago become less valuable because of the higher interest rates rising. So that's kind of been the story of what's happening in the fixed income. The Federal Reserve raised rates again at their past meeting at the end of September. And so the Fed's fund rate, which is the target for the United States Federal Reserve, increased, and there's also another meeting in December. So that could also show another rise in interest rates. So really, it's kind of, I was thinking about this the other day, it's kind of a tale of two stories, where the economic data that we're seeing, unemployment's very low, GDP, which measures the growth of the economy, is continuing to grow. That gives the confidence of our central bankers to raise rates. So they're seeing a healthy economy, something that's going to continue on for another year, another 2 years. They keep raising rates, and so that would be a sign of a healthy economy. Well, the markets are kind of maybe seeing it a little bit differently, where if they raise rates too fast, they can actually pump the brakes on the economy a little too quickly. And so it's kind of a push-pull, and it's always been, always kind of a push-pull when the Federal Reserve starts to raise rates. But so what we've been doing in our portfolios, and we've been doing this for a couple of years now since rates have been increasing, are more focused on the shorter-term bonds, things that might mature in 0 to 4 years, which don't have such a negative effect when interest rates rise. And what we look to the fixed income part of our portfolio is when the stock markets are doing the volatile motion and maybe having a correction, which means maybe down 10%. We look to actually sell some of our fixed income, which wouldn't have gone down as much, or might have actually gained money during that time of a equity market downturn. That's when we look to sell the fixed income and to buy into the equities, and then we use pullbacks as an opportunity to buy into the equity markets over the long run, which is something we call rebalancing. So for 2018, we've seen some volatility. Go back to January, where it was we started off the year very hot, and then towards the end of January into February, we saw the market pull back almost a part of a 10% correction at that time. So we've seen the market have some volatile turns this year, and we kind of expect that to continue as the world kind of reprices itself and readjusts itself to rising rates and kind of a different economic structure. So 10 years ago, we're back at the Great Recession or the Great Financial Crisis, and central banks around the world, they had to spur the economy, and so they lowered interest rates. They decided to buy back those non-performing bonds that were issued during the housing crisis, and they're really accommodative to the world's economy. So up till recently, it was still pretty accommodative. So until the last year or so, the United States started to raise rates. They're starting to turn back their bond buying programs called quantitative easing. They're starting to pull back on that. We're starting to see globally interest rates starting to rise. So as these interest rates and liquidity of credit gets pulled away from the economy, we might continue to see some volatility and some repricing in the market, but it's something that we expect and something that happens naturally in the general ebb and flow of economies and markets, and it's not something that we really feel is going to turn into the next financial crisis or something that's really going to be a deep, deep depression or something along those lines in the horizon.
Right, and I think just to add to, when interest rates are rising, if we kind of just think about this in simple terms, people are finding opportunity to have some level of, let's call it safe return on their assets. So what happens is they start pulling a little bit out of equity markets because there weren't any CDs or savings accounts that had any yield whatsoever. So essentially, it's almost like a reshuffling while people kind of get used to, well, where are rates going? We're seeing rates on money market accounts go up. So, just human nature is, okay, I'm just going to kind of get a little bit safer now and pull some of those investments and, redeploy them in kind of safer savings accounts because those rates weren't there historically. Again, it's kind of that balance. So we kind of let things settle, and we're not seeing any real cause for alarm in terms of, bubbles, which were, pretty existed when we had significant market crashes, if you want to call them. Those things don't exist today. I mean, I don't know if we want to talk a little bit about just what are some potential risks in the portfolio in terms of what are things we're keeping an eye on. Just geopolitical tensions or
it's always geopolitical tensions that could start a potential next recession or downturn. Some of the other things, what exactly is happening out there? It seems that you have Europe, you have different specific countries, we have Brexit. There's always some sort of headline. I think that's kind of our general philosophy. Is there's never really been a period of certainty out there, no matter what time period you looked at. Right now, it might be a Brexit or Italy having budgetary issues, or the fact that this whole thing with Saudi Arabia. There's always something on the headlines. That's how papers get sold. But that's when we have to check our emotions at the door when it comes to investing and really kind of maintain that balanced approach. And we think that the sun is still shining out there. We still think the economy, the global economy, even though it had a little bit of a slowdown earlier this year, we still think that's going to be moving forward, that the capitalism works and that we are going to see continued growth on a global scale. And we're going to be pushing this global economy forward. So as much as it doesn't, there might be some volatile days and looking at the Dow Jones Industrials, going down 500 points, big headline this morning. Well, that's but it's only 2%. It's a 2% drop in the stock market. That happens. That is just something that is happening, and it does happen. And so when you see big numbers like that in the headlines, we have to kind of remind ourselves of think about percentages and it's just still getting used to those bigger drops.
I think, one way to maybe close on, kind of wrap it up is, I love the way the gentleman at JP Morgan sort of put it. I think it was such a good analogy. Is if you think about when you're boarding a plane on takeoff and on landing, when you're in a smaller plane, you'll hear the pilot announce that he needs a couple of some people to move to the back of the plane, some people to move to the right side of the plane. And if you think about what they're doing is essentially balancing for takeoff and balancing for landing. So concerned people are, questions I'm getting these days is, should we start getting more defensive? Should we, go more cash? This is a takeoff or landing. We're always on the defensive in terms of how we're positioned for takeoff or landing. It's just kind of the way we operate just logistically in our portfolio management. And what they're trying to do is balance the weight, right? So you balance the weight so that the plane is not being affected by wind, storm, whatever is coming at it. So and you have that type of portfolio. That's the type of portfolio that we design for our clients, is one that's pretty much always prepared for takeoff and always prepared for landing, because it's balanced between equity and fixed income, and then also balanced from a global perspective.
Right. Yeah, and that's a good point. I mean, Nella alluded to it a little earlier. I think we do have one question coming in, and it's kind of about, it's a 10-year bull market, so to speak, here in the United States. Our equities, stocks expensive, and what should we be doing about that? And one of the things to look at is kind of valuations towards based upon historical averages. So when you're looking at valuations, and we could, this could be a whole different webinar on how to price stocks on price to earnings ratios, but one metric is price to earning ratios, and that compared to a global forward-looking price to earnings ratio is pretty much about average, meaning that in the U.S., it might be stocks might be slightly either fairly priced, maybe a little bit expensive, but the key, I think, is to compare it to the rest of the world, where on a relative basis, it does look like the stocks from abroad are actually on sale, or a better price. And when looking at the PE ratios, it might be a better deal to look overseas at your portfolio and really diversify away if you're really U.S. centric. Not to say the U.S. markets aren't going to do well, or they're it's time to run for the exits, or jump out the window with your parachute on if we're going back to the plane. But it's just a matter of staying balanced, and it might be an opportunity, some of these pullbacks, when things are doing, when they're negative, to look to purchase and rebalance the portfolio.
Excellent. Yeah, and I don't know if we talked about numbers, but the 25-year average price to earnings ratio is 16.1. Whereas today it is at about 16.8. So like Matt said, a little bit, not grossly overvalued, but we're near the average.
Yeah. So I have one more question for Nella. Nella, if I were to win the Mega Millions today, who should I call first, or what should I be thinking about?
Why, Matt? You should call me first. Yeah, so you have to build your team. Actually, that question's coming up. That's
Yeah,
a
we're
big
getting
question.
this question, so it's kind of fun to answer it today. It's
So
timely.
I think, building your team of experts, and I think as a financial advisor, one who's focused on the planning perspective, that will sort of be your quarterback to all the players that you need to ensure that you have the estate planning all solid. You're working with the right attorneys to put the right trust and whatever other types of family ventures you're going to create to manage to be a good steward for this wealth that's coming your way. You need to make sure you have a good tax advisor. While we're CPAs here and we can kind of guide you, we're going to make sure that you're working with a good CPA. You need to make sure that you plan accordingly. And the financial advisor is essentially key in making sure that you build a portfolio that you can actually do some really cool wealth transfer and legacy planning with.
For your next generation.
For next generation, yeah.
Very nice. Yeah. Very nice. Well, thanks, Nella. I'll be sure to give you a ring.
Thank you. And we're partners, remember that.
Yes. All right. Well, this has been great. I hope you enjoyed it, found it educational. Please do give us a call or let us know if we can help you with any of your unique personal financial planning questions. We're happy to do this, and we're really wanting to educate our clients to the best that we can so that they can achieve their goals and live the lives that they want. Have a great day.
Have a great afternoon. Bye-bye.